Hey everyone, welcome. Hope you guys had a great Friday. It was definitely action-packed at the beginning of the day, but got a lot more boring and a lot more quiet later on. Welcome. Hope you guys had a great Friday. A lot of chop later in the day. We just reacted to Powell. Actually, before he even said anything, like the moment he was scheduled to speak, we went soaring higher, and then he started speaking. We floated a little bit higher, and then just chopped sideways for the rest of the day. That's what I was talking about yesterday, where Powell could say something that completely sends the market one direction or another, or actually negates any of your trade ideas. In this case, he affirmed the trend. He affirmed the expectations of the market, so it went higher. This is screaming higher intraday, but on a day-to-day basis, it's really nothing, right? We are still talking about the exact same box that been talking about all week. So basically, we went absolutely nowhere this week. So if I draw this rectangle, we can say that we really haven't gotten anywhere. And from last Wednesday until now, we've basically gone zero. We're flat, and we're basically matching the all-time highs. So all we did was return and visit to the all-time highs, though it's a little too soon to be excited. However, this is positive, this is bullish, this is likely going to mean that next week we're going to start carrying forward momentum or upward momentum and continue to rise higher. Not super fast, not screaming higher, but steadily higher. The other reason to be optimistic about it is right now you see SPY, all it did was match all-time highs. And if we look at RSP made new all-time highs. So we're getting broader base participation in the markets. It's not just the AI stocks, it's not just the Mag 7s, although Mag 7s, let's see what the Mag 7s did. Okay, so they went up, they didn't even match all-time highs. So if the mags had matched their all-time highs, then the S&P would be up even higher because RSP made all-time highs. So we're getting breadth in the markets, and that means that we could see more bullishness across other sectors, not just the mags, or money is going to start kind of trickling away from the mags and start concentrating in a broader base of sectors. So another sign of that is IWM. IWM went screaming higher today. It was significantly higher, 4% higher. That's not a normal move for IWM. We are up 8.86. Its ATR, including today's movement, is just 4. So it doubled its ATR. Yesterday, the ATR was 3.33. So almost triple or 2.5 times its normal ATR movement today. That is significant. So money seems like it's been given permission to go into riskier assets. And this is great news for small businesses because basically what Powell said is, yeah, we're probably going to cut rates. And we're in an environment where it seems to be appropriate. It was basically what he says. And that means that if we lower rates, that's favorable for all business, but especially small business, which is dependent on debt, much more so than S&P 500 companies. And being able to access cheaper debt is very important for the smaller businesses, and they are far more likely to rely on shorter term debt, which is what the Fed funds rate controls or influences the most. So all of that is good news, and it looks like we are probably going to be bullish going forward. Now we do have seasonality. We are towards the end of the summer, and generally activity in the markets doesn't really pick back up until maybe mid-September. So it could take a little bit of time before we really see that hit the market. So that's why I'm not super bullish at the moment. But if I look at this technically, we've been chopping sideways basically from, call it end of July, a week before July ended, been chopping sideways except for that little dip down here. And we are then now bouncing off of the EMA 20. And this is a nice, big, huge confirmation bar. So it does look pretty optimistic that we are going to break out of this range. Jackson Hole was the catalyst that we needed in order to resume bullishness. And we'll have to wait for Monday in order to confirm that for sure. But it does appear that way so far. So let me say hello to everyone. I've given enough time for at least some people to show up. Hi, Lise. Hi, Spider Monkey. Hi, Cosmic Spiral. Sarah, good to see you. XLE broke out hard for the first time in a while. Yeah, XLE, the energy is moving. That is somewhat recessionary. That causes the prices for the input prices for a lot of business and especially manufacturing to go higher. So that can be a little bit of a dampener, but so far the market doesn't really care about that. And also we're not out of the woods yet. So if we look at this, oops, that's not. Okay, we're not quite there yet. We're not quite there yet. We still need to break out a little higher. Most likely we break out, pull back, maybe down to the MA 200, and then maybe we will go higher. But for now, obviously it's a step toward in the positive, in the upward direction for energy prices, but it's not confirmed yet. This could bounce right back down. So personally, I'm avoiding XLE for now or any energy related stocks. Hi, John. Intraday PA was fairly weak across after the speech. Yeah, except for XLY and XLE. Let's look at XLY. I wasn't paying attention. Into XLY, yeah, XLY all-time high. Nope, not all-time highs, but recent high. Nice little bounce off the EMA 20 over here as well. Okay. Hi, Jody. Okay, so yesterday, 4bro or C4bro, I don't remember his exact handle, but something 4bro, or maybe it was just 4bro, was asking me about Spider, asking if I use spider lines, and I did read up on them, and my answer now for sure definitively is no, and I will never use spider lines. So I want to go over that very quickly because it's an important thing to consider. So spider lines, if I look up what are spider lines, what are spider lines in trading? There we go. So spider lines is a tool used to identify potential future support and resistance, made popular, often associated with the real crypto face, which I believe 4bro was talking about as well. And basically they pick a point and then they draw lines to, so at the top of the candle body to a significant low or high. And so some examples that he ended up sending to me were this. Can I? Okay. So he sent me examples like this. Can you guys, do I need to change my resolution? I probably do. Let me do that. Okay. So we have to be very careful when we see things like this, because when we look at this, look at these green circles where he circled, oh, these look like points where these spider lines were really good and they predicted where something would bounce. Okay, that looks good in hindsight. It does not work for future projections. So we need to know if something is good in hindsight or if it's actually good for projecting into the future. So for example, this first green circle right here, that is invalid because I needed to use that green circle in order to draw this line. And then we'll see if these two levels are valid. I'll show you when I draw the line myself. And then over here, he just drew this right here. And then is this actually a good level? Okay, and over here, same thing. Is that actually a good level? Is that actually a good level? So basically we pick a point and then we draw lines to significant lows and highs, okay? So I'm gonna do that exercise without the benefit of hindsight. and we'll see what we come up with, okay? So that chart that I just showed you was on LHX. That was one of the stocks that we were talking about yesterday. What happened to my... Okay, so let's go over here and let's look at LHX. You know what, let me remove some of these lines. And we'll do this exercise, but I'm gonna, without looking, I'm gonna turn on replay and I'm gonna chop off a significant portion, okay? And then I'm gonna just pick the same point that that Forbro picked, which is here. And I don't know why he picked here. I have a huge question mark as to why you picked right here, because why is this identified as a significant level rather than this high right here? That's a big question for me. But even so, let me just accept that that's where we're going to pick as our starting point. Okay, so we'll pick here. The methodology is that you go to the top of the body of the candle, not the wick. Okay, so we're going to go over and we're going to go to the top of the candle. Which one? I'm just going to pick this one because it's a little bit closer to the edge. Okay, so let's just say not this one, not this one. Let's pick this one. It's the highest one right before the drop off. So if I go and I go to the top of that candle, and we're not going to be super precise, we're going to give it some benefit, and I'm going to draw it to this low right here. Okay, then I'm going to do this right here. I'll go take it to that high right there. Remember, it's the top of the candle, not the body of the candle, not the wick. And then I'm going to do this right here. That's a significant low right there. Then I'll do it right here. And remember, it's the top of the wick, or sorry, the top of the body, not the wick. So this, I wouldn't draw it up here. I would draw it right here. Okay, and then the other significant low that I see on this chart is perhaps that one right there, okay? And I can't draw it right here yet because I don't know if this is a high. I don't know if this is going to keep going up, and I don't know if it's going to keep going down, okay? So I need to know, do any of these lines provide me any sort of future predictive power? So if I step forward, okay, so far I have not touched any line. The market, this LHX is chopping sideways. Now it's going up. If LHX goes up, then we've got nothing to do here because all of these lines are lower. This is not going to help me on the way up. So when we're changing directions like this, it was going down, then it went flat, now it's going up. These lines are going to offer absolutely zero to me. So maybe they would have offered something to me if I picked this line to draw lines, but I don't know. We would have to do that exercise. But let me finish this exercise first before we decide we want to spend any more time trying to analyze this. So let's just say, okay, so let me go forward, keep on going. You see that? I don't even know that I couldn't draw a line there either because I don't know if this is a high or not. And actually it wasn't. It kept on going up. So I can't draw a line yet. I can't draw a line. That's maybe that we've now seen a high. I can't be super certain. Okay, and now, okay, this would be not necessarily a significant high. It is a high. I don't know if I call it significant, and we're supposed to only draw lines to significant lows or highs. Okay, so how do I decide if that's a significant high or low? I won't know until several weeks later whether this is a significant high or low. But let's just pretend. Let's say, oh, okay, well, let's just say it is. Let's just say it is. Okay, and I'll draw it to that high. Okay, and let's see, did that line provide a level of support or do we just violate it? The answer is, maybe. Hard to say for sure, but it wasn't precise, right? We went through it. Maybe you could say that was a support line. Okay, fine. How is that different than me just drawing a horizontal line right there and calling that the support line? Same thing, right? So far, the spider line has not told me anything that a normal line would tell me. Why would I draw a line here? Because we've got this movement right here. Maybe it'll go a little lower. We got a lot of chop right here. Okay. And then we re-enter this region, and now we chop across that same line. And over here, we have a local peak, local peak, local peak. Okay, so this actually is a significant horizontal line by normal supply-demand methodology. So far this spider line hasn't given me anything useful that any other method would not do. Okay, and then let's keep going. Okay, I don't know if that's a high yet. Okay, so not a significant high, also not a significant high. Now we have a gap up. Maybe that's a significant high. Probably I could call that a significant high. So now let's give it the benefit of the doubt again and just consider that a significant high. And do I draw it to the wick? No, I draw it to the body of the candle, correct? So let's do that. Okay. Okay, and that's it. That's it. So far, this thing is not over. And I don't know if it's actually reacting to this last line that we drew. But again, if it is reacting to this last line that I drew, I would just use this as a horizontal line, right? And then it would, so we're actually reacting to this level and not necessarily a level up here. So far, I don't see any sort of predictive power in the spider lines. I'm not convinced. It just looks good in hindsight. It looks good in hindsight because if I draw a bunch of these lines, then chances are, yeah, I'm going to find something time where it crosses, where it looks good. It doesn't have predictive power. So I could not have said, oh, let me say, when I'm right here, could I say that, oh, we're going to trade all the way up to here? No, because I couldn't draw this line until we traded all the way up to here. Does that make sense? If I put this replay, if I redo this replay right here, and I say, hey, looks like we're going up from here, we're deviating from this orange line, I can't say we're going to trade up to this orange line up here because I can't draw this orange line yet. I don't have a second point for this line to even exist. So there is zero predictive power there, right? I can't draw that purple line until it actually I have a clue that that's actually a significant area, right? So I can't draw until now. So it didn't have any predictive power for me to say this trade could go from here up to here. So far I am completely unimpressed by the spider lines, and I don't know what other people are using it for, or the crypto, whatever his name is, Crypto Republic or crypto, whatever, real crypto face. It sounds like, or looks like to me, like he's just looking backwards, and say, oh, these lines look good. Well, they look good in hindsight. They don't, they don't really. So far, I haven't seen any predictive power. And I did the same thing on SPY. I did the same thing because I was shown SPY lines as well. And when I looked at them, it was the same story, right? It's the same story. If I look over here, was this SPY? This was something else. This was like a crypto or something. Okay, so again, I can't. Where's the origin point of these lines? I can't see it, right? So where do I decide where to start drawing these lines? So they didn't show me the screenshot of exactly where these lines started. So I can't tell you whether, I don't know if this is point number 3 or 4 or 8 or what on this line. How many times has did this line actually predict that? Or is it just the first point that we could draw through? Okay, so I'm not convinced. I wouldn't use it. I know no institution is using this. So if it works on cryptos, because real crypto face has a huge amount of influence, I don't know. I'm not super big in the crypto space, so I don't know if he has a huge amount of influence. Then maybe his followers are using it, and therefore there's a little bit of predictive power in that. But again, once institutions come to play in that play box, that advantage is going to disappear. Okay, so I'd be very careful about tools like that. All right. Okay, let's see what you guys are saying. Is TLT still looking weak? I will take a look. Hey, Forbro, there you are. Yeah. Oh, I just went through that methodology, Forbro. If you rewind or you check out the replay, you can check out my analysis of it. Yeah. Okay. So I'm openly talking about this, and I'm openly giving my honest opinion and I'm hopefully giving you my testing methodology to see whether or not it's a valid, if it's good for predictive power, which is the only reason why you would want to use it is if it could somehow give me an edge for trades in the future. And so far, I haven't been able to see it, unfortunately. It'd be nice. It'd be nice, but so far I don't see a real edge in using those lines. Is TLT still looking weak? Well, it's chopping sideways. It looks like a little indecisive. So the Powell gave it not even that much of a boost. Intraday, it was moving, but not that much. All right. Enjoyed seeing you and Roger diagram low risk, high reward earnings plays in his VIP room a couple of Fridays ago. Any chance we could test one for NVIDIA this coming Tuesday? So NVIDIA is unlikely going to be able to provide you the low risk, high reward earnings because the options on NVIDIA are very expensive. So if you want low risk, high reward, then you want to be able to go in for, say, $1 or less into your spread. And then that way you're only risking that $1, but your potential reward is many multiples of that. Now you could get the same relationship and say, hey, I need to put in $1,000 and maybe I have the potential to make $10,000. But the problem is you have the potential to lose $1,000 instead of just 100. And if you're scaling up and if you're going in size in many contracts on the $1 spread, then same thing. Yeah, you've just multiplied your risk to the same the overall risk dollar amount. But the point of these types of plays where you have really large reward to risk ratio is that you want to keep your allocation small. So a lot of people will say, oh, I can risk $1,000 to make $1,000. That's a 1-to-1 reward risk ratio. And if that's your normal trading pattern, let's just say that's your normal allocation, $1,000. Well, on these ones that have really high reward risk ratio, I wouldn't be doing the same thing. I wouldn't be risking $1,000 to try to make $10,000. What I would do instead would be like, look, now I can only risk $100 to make the same $1,000. You see that? So I don't let greed take hold of me. I don't say, normally I make $1,000, now I want to make $10,000. I say, normally I risk $1,000 to make my $1,000, now I get to only risk $100 to make that $1,000. Do you get the difference? It's like, it's the same opportunity, but it's a very different psychology. It's not like, so rather than letting greed rule me and say, I might make a whole bunch of money, I say, I can make the same amount of money with way less risk. And that makes me super happy because now my money is a lot safer, okay? So that's how I would use those types of opportunities. So NVIDIA is unlikely going to be able to give us that because their options are so expensive. And actually what's more important is the distance between the strikes. So if I go over here and I look at, let's see, sorry, I got some, shouldn't show you some accounts that I have for people. Okay. So let's go to NVIDIA, and the distance between strikes is $2.50. Okay, so maybe we could find one, but and again, that would be the day before, and you would want to trade it during the session. So in a post market, I'm probably not going to be able to show you any earnings play that requires you to trade the session before the earnings is announced. I can really only show you things that are traded ahead of time, 1 day, 1 week, 2 weeks before earnings. So unfortunately, with a post-market show, I can't really highlight any earnings plays that take advantage just as an overnight trade. Yeah. Thanks for taking the time to explain that. All right. The risk reward thing, I think, yeah, that's good information to know. It's a very important distinction in trader psychology. After a day like today, how long does it take to determine which sectors have established new bullish trends versus a temporary pop? It depends on what it looked like before. So for example, if we look at XLY, right? This has been a pretty bullish trend. And as it looks very similar to the overall market, it is weaker to the market. It is not at all-time highs, but this has been a bullish trend. And we bounced off of some significant support areas over here. So we could pretty safely say, and then you also have to say, like, how is this sector influenced by interest rates? If we have lower interest rates, does that help consumer discretionary? Does that help the consumer? The answer is yes, but cost of capital is cheaper. The cost to borrow credit is cheaper. To put things on my credit card is cheaper. To get a personal loan is cheaper. To put a refrigerator on financing or a car on financing is cheaper than before we were confident that we're going to get the rate cuts. So that is in support of the existing trend already. And so XLY is probably going to continue the trend. Then I could say, well, healthcare, how about healthcare? Well, healthcare chopping sideways. Does rates really help healthcare? Do people care if they can get cheaper financing on healthcare, which you don't, right? The financing that's offered is generally offered by the hospitals themselves and not a bank or an institution. So they're completely independent, not completely independent, but they can be independent of the rates that we see in the markets because they're not banks and lending institutions who are providing that funding. So probably not. We are probably not in a new bullish uptrend in XLV, which we weren't before. And we're still below resistance anyways, so we wouldn't be thinking in that direction. But let's just say that it poked above the MA200 today. Would I be keen on this going higher and establishing a new bull trend? I'd say no. It would have to prove it to me. It would have to prove it over a number of weeks. Okay, so the length of time that is required to decide whether you're in a new trend is going to be different based on which sector and its relationship with interest rates. Okay. I did look at it objectively, bro. I looked at it very objectively. I showed how a lot of those lines, you can't draw them ahead of time. You can't know those levels ahead of time. So let's go back to L. I'll do one more example. So how do you know where to start? That's a big point of discussion. Okay, so let me go all the way back to here. So I don't know that this is a low, so I can't start drawing lines yet. Okay, so now I know that this is a high. Do I know that this is a significant low yet? Maybe. You can maybe make the argument of that. Okay, so I'm going to start drawing right here on January 7th. Where's my next opportunity to draw a line? Okay, that's a low. Okay, so I will draw a line through that low. Okay, you can't draw these from today and draw them backwards. That's giving yourself the benefit of hindsight. You got to be able to do this in real time, which is what I'm simulating right now. Okay, so I do that. Does that line help me? I don't know yet. I've got to wait for a lot of time to pass before I know that. Okay, we bounce off the MA200. I can decide that that is an important high. But according to the methodology, I do not draw it to the wick. I draw it to the body. Okay, so I'm not going to draw it to this one. I'm going to draw it to this green one. Okay, so, and you know what? Let's give it the benefit of the doubt. Let me also draw it to the wick. Maybe the methodology that I looked up was not correct. Okay, so I'll draw both and see if either line is helpful. Okay, and then. Okay, here we go. We bounce off the MA200 again. Did we respect a line or do we respect a well-established institutional level? We respected a well-established institutional level. Do I call that a important high? I don't know. Do I call that one an important high? I don't know. But let's give you the benefit of doubt and let's draw both of those. And if I draw enough lines, eventually one of these lines is going to look good. So what I want to know is every line a good and significant level. That would be a reliable methodology, not one line in 20 that I draw becomes a significant level. Okay, that would be a useful, that's what makes a useful predictive thing. Okay, so we violated this one right here. So this one did not provide a good level. This one, maybe, we don't know yet. We'll see. Nope, did not provide a good level. How about this one? Maybe, or at least we got kind of close on this red bar right here. We'll see. Nope, violated that one too. Okay, trading right through them. Okay, and then we can say, okay, maybe this line for maybe a little bit, it was, but you see that? We trade right through them. We don't actually pause at any of these lines. But so far, the best line out of all the ones that I drew is this one right here. And maybe, well, I don't know about this one yet because that's far into the future. But if I look at this, okay, yes, did it bounce off of this line right here? Yes, it did, but actually it was also just reacting to its EMA 8. Those two happen to be the same level. Right? Here we traded right through it, and then we bounced off of the EMA 20, then we traded right through that line again, then we did appear to bounce off of it right there. So the only time has been this candle right here. Okay. Oh my gosh, why can't I draw? Okay, it's only been this one right here so far on this uptrend. And then, so can I say, did it have predictive power? Could I, when we were way down here, if I decided to enter on a breakout above the MA200, could I have said, oh, it's going to trade up to this line? Well, okay, so let's be fair. If I did that here, at least I would have gotten out at a profit, okay? But then could I then say, oh, we're going to continue? Can I trade this trend upwards? If I traded the trend upwards, then it no longer provides me a good exit, right? So it's just saying that we're sort of kind of trending along this line. Right? So if I keep on going, then now we're at the end of it. So maybe it appears that we did bounce off of that line again. But then what do I call that, an entry point? And then where does it then subsequently trade up to? Do I set this one? Remember, these two lines, I can only have one of them because either I'm trading it to the top of a body of a candle or I'm trading it to the actual high of the candle. So let's just call this not a good line either. Okay. So if I don't have a good line here, then I no longer have predictive power. Where, if I enter on a bounce off of this line, where's my exit? Where's my target? Okay. So I don't have predictive power off of that line. Then you'll probably say, well, then you got to draw more lines. You got to draw lines from here, right? Which is the original point where we drew lines from, right? Well, when we did the first exercise, like, okay, and then I'll draw lines here. Eventually, I'm going to draw so many lines. How do I know which lines, right? Because remember, we invalidated all these lines down here. I don't know which lines to listen to and which lines not to listen to. And if I draw enough lines, it's going to be completely cluttered. And basically, every single level is going to look like there's a line drawn through it. So for me, it's objectively, my honest opinion, objectively, that it's not that helpful. And maybe some people can use it and find it very helpful. But for me, I wouldn't be able to use this. I wouldn't know where my next level is because I wouldn't know which line to listen to. Okay. Probably the profit goes down on increasing your risk. Yes. Can you send my email again? Yeah. I mean, Kane@investpub.com. There you go. They report Wednesday after market. NVIDIA does. I'm just drawing random lines on random. I don't know. I'm following the methodologies of spider line trading. Okay. So what are the starting points for it. But anyways, yeah, we don't have to go. If you're saying I'm not following the methodology, then I'm not following the methodology. That's fine. Okay. But here's the point. Like, there are so many ways in a market to gain an advantage, to gain an edge. There's many, 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 many different ways. If spider lines give you an advantage, go for it. I'm all for it. Anything that makes you money, I am 100% for. Okay, as long as it can consistently and reliably and predictably. Because remember, what is gambling? You have to know and calculate your odds and expectancies. Okay, so if it can consistently and in a mathematical way help you get that mechanical edge where it repeatedly makes you money, then go for it. I'm 100% for it. But there are also dozens and dozens and dozens and dozens of other ways to make money, and which one gives you a better edge. So you follow spider lines. I don't know the premise behind the spider line, but I follow institutional money, and I know the exact premise behind institutional money. So not so both ways it's possible. I don't know the details of the spider lines. So if you can use it to make money, go for it. I'm not here to convince anyone that my way is best. It's definitely not. All I know is that my ways of pulling edges out of the markets consistently make money. And on average, they make more money than they lose. So I'm going to continue to use them. I don't need to convince anyone that, to use mine or not to use mine. If you find a methodology that works for you, that makes you money consistently, go for it. Go for it. Go for it. All right. Yeah. Okay, cool. So let's, there was something else that I really wanted to show you. Oh, so LHX, what happened today? I closed out of the trade right before Jackson Hole. So if we look at LHX, right before Jackson Hole was at 7 o'clock. So I got out right here. I missed this surge upwards, but I also missed this crash downwards. So I made money on this gap up, basically. So that was a nice and profitable trade that we got off of my Gamma Pocket software. So that was another nice win from LHX. I think 2 days, was it a 2-day hold? Let's see how much that was. And how many days back? I'm just proofing the software and the leads that we get off of it. So I'm only doing one contract right now, but we did the 1 month out, 475, 388. So probably like 24-ish%. 4.75 by 388. 22.4%. Okay. Pretty close. That was a pretty close guess. And that was from the 20th to, so 2-day hold right there. Not bad. And it's actually a day and a half because we exited pretty early and we entered pretty late. So LHX did very well. And based on the software scans today, which I was going to show you over here. We've got this scan that we did after Jackson Hole. And based off of these scan results, I took an opportunity on Google. I took an opportunity just to proof. Usually I don't like to trade on Fridays because I don't want to take the time decay immediately after a trade. But I'm just proofing the scanner results right now. So I took a trade on Google. I took a trade on Citi, and I took a trade on Pepsi. And these were later in the day after Jackson Hole. So basically we didn't have that much time in the trades. Then obviously we're going to swing them past the weekend. But you can see that so far right? Citi is flat, basically, sort of down. Google up 12%, Pepsi up 3%. So they're off to great starts. I'm very excited about the progress we're making in the software. All right. There's something else I was going to show you guys. But let's talk about overall markets. If we have basically Jackson Hole, the market did get what it wanted to hear. So someone asked me yesterday, oh, what do you want to hear from Powell? Well, basically my answer was clear indication that we're probably going to get 3 rate cuts. And his line was, I threw it out in my Telegram channel. I said the most important thing that he said for the markets was that shifting balance of risks may warrant adjusting our policy stance. So basically it's saying like, oh, well, yeah, the data is moving and we're probably going to have to change what we're doing, which means cutting rates. Okay, so that's what the market interpreted it as, and that's why we were up. But then after that catalyst, how much firepower did it really have? All right, actually, a huge majority of the gain came right before he started speaking, and then he affirmed it, and so we just stayed up, basically, is what happened. We didn't really move much higher, and by the time we closed, we just closed at the same place, okay? So why is that? Why was there no continuation, no follow-through? It's because it was already priced into the market, right? The market was saying, we want 3 rate cuts. We want indication that we're going to get 3 rate cuts. Oh, we got the indication. We got what we wanted. So it's already priced in. If he had said, oh, we're doing an emergency rate cut today, and we're still considering an emergency rate cut on September 17th, then this would have spiked up and kept on running, okay? Because that was not priced into the market. Or if he said, oh, we're only going to get 2 rate cuts, or we're only going to get 1 rate cut this year, or we're not going to get any rate cuts, then this would have tanked really, really hard because that also was not priced into the market. So if we get exactly what the market is expecting, then the reaction is going to be a lot more muted. There is a little bit of a reaction because there's still some uncertainty. We don't know, okay? And then we price in that uncertain, or the uncertain thing becomes certain, so we price that in. And then there's nothing else. The catalyst is done. It's over. So there's no more firepower left to Jackson Hole, and there's no more firepower left to a rate cut. At least not much firepower left to a rate cut. So between now and September 17th, we can no longer count on a rate cut happening to stimulate the S&P 500 to new highs. Okay, so that's really important. So what else? What else can stimulate us to new highs? We already have the Fed put, we already have the Treasury put, we already have the Trump put. What else can we get? So from here on out, we're really going to need earnings. Really amazing earnings. Those are probably the only thing left that can continue to drive the market higher. We can float a little bit higher, but to really significantly move higher, we would need some sort of driving force. So to tell the market, say, hey, there's some information that you haven't priced in yet. Go, hurry up and go and price it in. And they would scramble and price it in, but either down or up, depending on that information. Okay, but for now, we're out of catalysts. So while I'm optimistic about next week, I'm not expecting it to go a lot higher. I'm going to actually kind of expect it to just keep on sort of chopping or just kind of sort of drift higher. Yeah? So hopefully that makes sense. Yeah, you're right, Bro. I can't say it doesn't work because I don't know. You're right. I don't know about the spider lines. All I know is that what I looked up on that methodology. Yeah. Price normalized at the high in the box. Yes, that's right. To the intraday, we normalized high right here. And then after Jackson Hole, what I said was that in my Telegram channel was that we said that, hey, after this was while he was still speaking, I said, okay, we've got gamma at 645. Now that the bulk of the catalyst is done and we're working our way through it, now it makes sense to look at gamma exposure. And so now we look at gamma exposure, we see this huge spike at 645. I say, okay, we were trading up to 645 at that point in time. I say, hey, don't get too long here. Don't expect that we're going to go to 648, 650, that we're going to keep on climbing higher. This is probably about it for today. I said, it does not mean that we will reject 645. 645 could be sticky, but we're probably going to have difficulty going significantly above 645. And that's exactly what happened. We made it sort of kind of to 646, I think. Yeah, it's a little over 646, but then that's where we were chopping. And we ended up at 645.29, which is pretty close. On SPY, if I'm within $1 up or down, that's pretty good. That's pretty close. And so I'm very happy, because if I know within $1 of where SPY is going to go for the day, I can make a lot of money. There's so many ways to take advantage of that information. I could do a butterfly. I could do a vertical call spread, or a credit spread or a debit spread. Doesn't really matter. Either way, it would take advantage of it would be the same way of taking advantage of it. I could build an iron condor. I could buy a simple call or simple put. There's so many ways. Once I know within a $1 range, or I guess you call it $2 range, because it's up or down, up above or below that spot, and there's so many ways to take advantage of that information. So that's pretty valuable information. Those are the types of things that give me personally an edge when I trade. Okay, so expectations basically even though we are now past the period of uncertainty, it still looks like chop or maybe floating upwards, simply because we're out of catalysts. Maybe let me look at the economic calendar, maybe make sure I don't put my foot in my mouth. But I'm pretty sure we're out of catalysts. Let's see, Friday, Monday, Chicago Fed, new home sales. Yeah, nothing much here. And then, can I not get beyond that? I don't know why I can't get. Normally, oh yeah, there we go. Okay. Tuesday, durable good orders. Consumer confidence at this point won't matter as much. As long as the consumer is not going to go into a credit crunch, then we're not going to worry about the consumer. If the Fed starts lowering rates, it's far less likely that they're going to go into a credit crunch. So that's not going to be super significant to the market. Nothing really on Wednesday. GDP, okay, GDP. But if it's significantly different than the forecast, could become a catalyst. But if we come in within range, or just a little bit up or a little bit down, I don't think anyone's going to care at this point. Especially if it affirms that we're going to get 3 rate cuts this year, then it won't really care. And then PCE, personal income. Okay, this will be a little bit of inflation data, so we might react a little bit to that. But again, at this point in time, the market has pretty much concluded that we're going to get 3 rate cuts. So I don't think we'll have a huge reaction to it. Okay. All right. Emergency cut might spook the market. Yeah, that's true. Sometimes it does spook the market. Like if we're not seeing conditions that warrant it, then yeah, that would spook the market. Yes. NVIDIA on 8:27 a.m. All right, let's take a look at it. You guys have asked me enough times. I'll take a look at NVIDIA and NVIDIA earnings. Okay, so we've been chopping sideways. There's been no real catalyst for NVIDIA. So if earnings come in off expectation, it could be stimulus for a large move. So over here, the most important thing to know when you're trading for earnings is the implied move. Like, how much do we expect NVIDIA to move, or how much is the market maker expecting NVIDIA to move? So between now and next Friday, what the market maker has priced in is about a $13 move right there. Okay. Another way of me knowing that is sometimes as we get closer to it, you'll also get the market maker move on Thinkorswim. A couple other platforms will give you that as well. But market maker move is basically Thinkorswim's proprietary calculation. But a great proxy is if we go to the at the money strangle and basically just say this is roughly $5.30. This is roughly $7 and call it 10 cents. So that is roughly what, 12.50, 12.40, 12.50. Again, over here, look, it's 12.92. Okay, so that's pretty close. That's pretty close. So basically, the at the money strangle gives you the market maker's expected move for the underlying leading up into the event. And then the other thing to know is how much are we expecting volatility to drop? The most important phenomenon when it comes to earnings is that you have generally, not always, you have a volatility crush, an implied volatility crush. So when it goes, because something is uncertain, and the more uncertain it is, the larger range we have right here. So right here, for example, today's expiration, there's no uncertainty about it. We know exactly where it closed. It closed at 177.99 unless that's an aftermarket number. Okay. So if we look at the implied move right here, this isn't updated for aftermarket, obviously. Otherwise, I would say 0 because there's 0. We know exactly where it closed. As we get closer and closer, we should have more and more certainty of where it's going to close, because if there's only a minute left in the market, how much can it really trade? How far can it really go in trading, unless there's some really weird black swan type of event. So you see how that is a very small expected move right there, 30 cents. Right? As we were approaching the close of today, that expected move went down to 30 cents. 30 cents on a nearly $200 instrument, which is, we're talking tenths of percents or even less than tenths of percents. So what I want to know is how much does it crush down? And so you can look at this percentage, or you can look at the difference between these prices. Okay, so if I go a week out, the range is roughly $13. If I go another week out, the range is only another $3 on top of that. If I go another week out, the range is only another $2 on top of that. So basically what we're saying is that first week is really uncertain. If I go 2 weeks out, 13 out of $15 of the expected move is due to that front week. Okay, so that we are expecting a volatility crush right there. And if I do it in terms of percentages, that is about 11% volatility crush. Now that is, so for me, that's not hugely significant. On something like NVIDIA, for it to only crush only 11% after earnings is kind of crazy. Because on these tech stocks, so what's another tech stock that is reporting? Next week. Those aren't necessarily tech. Let's try CrowdStrike or Dell. Okay, CrowdStrike or Dell. Let's go over here to CRWD. Okay, and you see here we've got 80 down to 63. That's 17. That's a bigger crush than on NVIDIA. Even that's not that big either, though. Let's see, what was the other one? Dell. I'm not expecting a huge one on Dell either. 82 to 63, that's roughly 20. Okay, so even bigger on Dell. But sometimes we see things, oh, Snowflake. Let's look at Snowflake. Okay, well, 24. At least they're getting bigger. But sometimes oh, here we go. Well, this is, did it already? When does the snow, maybe they report on Monday. Snow reports on the 27th a.m. 27th a.m., which is Monday, right? Monday morning. Yeah, so this was the session before the earnings call. So actually what we need to look is this one. Is that volatility crushes from 276 down to 104. So it crushes 170%. Then it goes from 104 down to 80, crushes another 24%. And then you see the rest of these, they're pretty close together for the most part. 1 or 2% apart, 5% apart versus 170% apart and 24% apart. Okay. So this is a really nice volatility crush. And so that's one of the most important characteristics that I personally look for if I'm going to be trading earnings. So I want to know that volatility crush, because if I'm not aware of it, that crush can either make me a lot of money or can absolutely destroy my trade. So if I go and I buy a call, and even if I'm right, and even if I'm significantly right, that volatility crush can just suck the life out of it. So let's do a Snowflake call. Let's see if I can get a good example of that. So if I go to option strat and I go to Snowflake, and I just do a simple long call on snow, and snow, and let's just say I did next week expiration 200 strike, and let's just say it goes up to I don't know, 210. Monday morning it gaps up to, what's the expected move? Where'd it go? Well, the expected move out to next Friday is, why can't I see this? Okay, here we go. 22. Okay. So let's just say it actually moves 22. It probably wouldn't, because the expected move just for Monday wouldn't be the same as Friday. But let's just say it does. Let's just say 220. Let's make it easy and say 220. So it looks like I should make 146%. The problem is that implied volatility, the option strat already has it at 104. It should be 276, because basically the market closed, and so they shifted this down to 104. Okay, so see that 104 right here? So technically right now it's still 276. Let's pretend the market was still open. We still have 5 minutes before the market closed. It would still be at 276. Right? So if we get that crush, we crush down 170%. I can't simulate that because they already moved it to 104. But let's just say it crushes by more than half, right? So if I go 104 divided by 276, it crushes by nearly 70%. Or 65%, doesn't really matter. Okay, so I go down and I crush this all the way down to 35. Okay, my 222, I didn't make 146% anymore. And then if we crush all the way down, because it actually crushes 170%, this won't let me crush it any further. So at the very least, so what's happening here is you see that curve didn't change. It's because it's all extrinsic value now. Basically, I lost all of my, intrinsic value. I lost all of my extrinsic value in that trade. So we said 222. Okay, so all the extrinsic value would have gotten sucked out of it, and then I make money only on the intrinsic value. So probably a better example is if I didn't allow it to go to 222, I go to a point where it doesn't have that much intrinsic value. So if it moves upwards, and just say we bought that 200 call, and just say 206. Okay, I should make 53%, but that volatility crush actually sends me negative. So the price I paid for the option puts me at a point where there's basically zero intrinsic value, even at 206. And so therefore I lost money because I lost all of my extrinsic value just from the volatility crush. Okay, so we want to be hyper aware of that for earnings trades. So I didn't get to do a full earnings trade or full examination or fully examine NVIDIA, but we got the most important thing, okay? Expected move, or two most important things. Expected move and volatility crush. Those are the two most important things you need to be aware of when you are trading earnings. Okay, so that'll be it for today. We are at our ending time. So hopefully you guys are still learning a lot. And you know, I'm always open to new methodologies, but also I also want to emphasize focus, right? If you have an edge somewhere and you can exploit that repeatedly, you have a gold mine on your hands. So don't keep on chasing new shiny things. So for bro, if you're making a bunch of money using spider lines, keep on doing it. I'm all for it and I applaud you for it. I would say keep on doing it, and you probably don't need to learn anything from me because if it's making you a whole bunch of money, then you should just stick to it. Just keep on sticking to it. You should probably have a couple of different methodologies because different indicators will be in different systems will behave differently in different regimes within the market. So whether we're chopping sideways with volatility, chopping sideways without volatility, trending upwards with volatility, without volatility, trending downwards with volatility or without volatility, those are all different regimes within the markets, and different strategies will perform very differently during those different regimes. They might do really well in 3 or 4 of them and then really suck at 1 or 2 of them. But no strategy will survive every single combination of those all the time. There will be performance dips. And so one way to protect against that is having a few different strategies, a few different edges that take advantage of completely different phenomenon or are strong at different regimes within the market and weak at different regimes in the market, and therefore they will balance each other out. Okay, so stick to it if you're making money with it. And then the only reason you would want to learn from me then is if you needed a system that's based completely on something different so that the two systems could smooth each other out. Okay. All right, guys, I hope you had an amazing week. I look forward to next week. We're probably going to get at least a little bit of a flow upwards in the markets. And so a resumption of bullishness is pretty likely. Have a wonderful weekend, and I will see you guys later. All right. Bye, everyone.